You might have noticed by now that I have a pretty large set of trading strategies. Running many trading strategies leads to diversification, which reduces overall risk. But as you can imagine, running a large number of trading strategies can be a huge headache. The truth is, in my daily trading life, I typically stick to a handful of trading strategies that have proved successful over the past few years. I frequently re-backtest these strategies to ensure their efficacy in the present. Every year I make some changes, moving out the least successful strategies from my toolbox while testing new potential strategies. Today I want to show you my top 5 trading strategies going into 2022. I suggest adding at least one of these to your trading toolbox in 2022. And almost every type of trader with any amount of capital can apply these strategies. So here are my top 5 trading strategies for 2022 in no particular order. Number 1, gap trading. I began my trading career with gap trading, and the practice remains one of my main go-to strategies. Gap trading is as it sounds, making a trade after a price gap. You can easily see a gap trading opportunity by looking at a chart. Price gaps occur over various circumstances, but the most well-known instances of gaps tend to be news-based. For example, a company could have just reported earnings that fell outside of the analyst expectations, creating a new trading region and a gap in the stock chart. Actually, I often employ gap trades after earning trades, which I'll talk about later. Here are some examples of gaps. When a stock trades higher after a gap, we call it an up gap. And when a stock trades lower after a gap, we call it a down gap. You can see that the stock essentially skipped over some prices, creating a gap. It is only a gap if both the candles and the shadows clear the gap. Remember, candlesticks are created from the open and close prices, while shadows are created from the high and low prices. As for actually trading gaps, we can consider gap trading a sort of technical-based trading system. I've backtested thousands of gaps over my trading career and found that most gaps can be traded based on what they look like in the charts. Even better, unlike other technical analysis, predicting the post-gap movement is entirely objective, unaltered by the eyes of the trader. A gap is defined as an empty space between 2 days' successive candlesticks and can be mathematically defined by the lows and the highs of said candlesticks. This mathematical definition has allowed me to backtest any gap I see, leading to my gap trading rules. These rules themselves can be found in my gap trading guides on my website, but we'll go over some basics here. First, gaps can be classified into many types. But I found that only 2 main types matter, those that fill and those that widen. For simplicity's sake, let's just call them area gaps and breakaway gaps, respectively. You want to bet in the direction of a gap for area gaps and bet against the gap for breakaway gaps. Area gaps are great because they provide us with an immediate price target. Breakaway gaps are a bit harder in this respect, but offer bigger potential gains than area gaps. Think of area gaps as reliable, high-probability, short-term trades, while breakaway gaps are their kurtosis-heavy brothers. I prefer trading area gaps using options as leverage. Even a $1 area gap can equate to $100 in profit per option over the course of a few days, as area gaps tend to close quickly. Here are some benefits of trading area gaps in 2022. Gaps are increasingly common these days. You would think that with increased liquidity in the markets these days, that gaps would be rarer as liquidity reduces large movements in price. However, as per my data, gaps have become much more frequent in the past few years, more than double in number compared to 1 decade ago. Obviously, this means that gap traders have many more potential trades today than ever before. With area gaps, you get high probability predictions of a stock's short-term direction. This is a rare find in trading. Even the best technical patterns are not as reliable as gaps in predicting short-term price action. Area gaps give clear, objective price targets. If you're trading an area gap, you don't need to make any decisions with regard to price-based exit strategies. In addition, you know right as you see the gap your potential profit. Most area gaps close quickly, and so you can also get an easy time-based exit strategy. For example, the average time it takes an up gap to close is 5 days. If you are like me and don't particularly like price-based exit strategies, you can, for the instance of an up gap, an up area gap, buy the next week's weekly put options and close before the expiration date. Gap trading, once you know the rules, can be done quite quickly. I generally only need to look at the size of the gap and the colors of the candlesticks surrounding the gap to determine whether the gap is an area gap. This allows for a quick and easy position entry. For more on gap trading, check out my website in the description section below. Number 2, sideways trades. The market is beginning to show signs of weakness. During times of investor indecision, we often see a crabby market. Just as a crab takes a few steps to the right and then to the left, retreading its path, the market often goes nowhere. The most basic investors are long only. A smarter group also engages in short positions, but the very best traders can also profit from sideways movements or consolidation in the market. I expect to see a lot of consolidation in 2022. Valuations are stretched, but to counteract this are the ideas of FOMO, or fear of missing out, and TINA, or there is no alternative. FOMO pushes the market up after a rally, as investors rush to buy stocks so as to not be left out of the next rally. TINA pushes the market up merely due to the idea that there is no superior investing alternative to stocks. You either buy stocks and profit, or you are stuck in investments with minuscule returns, such as the near 0% ROI that bonds offer. So these two effects put upward pressure on the market, but the overboughtness of the market, as judging by financial metrics such as the price to earnings ratio and EBITDA to EV, will cause investors to hesitate hitting that buy button, lest they buy at the absolute top. While the market loses its momentum trading sideways, we can still profit via one of the several option strategies designed to profit during consolidation. The easiest method by which to do so is the calendar spread, which requires a mere $2,000 in your account and does not require margin. In a calendar spread, you profit from the difference in time decay of two options. You hold long one far term at the money option while selling short a near term at the money option. As long as the stock you are targeting stays within a tight trading range, you will end up with a profit by the expiration of the near-term option. Here is an example of a calendar spread using puts. The SPY at the money near-term October puts are trading at about $150 each, with a theta value of 0.35. We sell these while buying the November puts, which cost around $900 each, having a theta value of around 0.10. The position costs us about $750 to open, but our net theta value is around 0.25 as we subtract the theta value of the long puts from the short puts. That theta value of 0.25 implies that we'll be profiting to the tune of $25 per day if the SPY trends sideways. Once the October puts expire, we sell back the long put to capture that profit, which should be around somewhere $100 to $200, equating to about a 20% ROI over the course of a week or so. For more on options trading, see my options playlist in the description. Number 3, seasonal trades. I've been using seasonal trading strategies for as long as I can remember. While many will tell you not to attempt to time the market, some stocks, sectors, and ETFs have reliable seasonal patterns that you can leverage. In a seasonal trade, you are taking a position over a unit of seasonality, such as a month or even a season, for example, holding a position over summer. In such a trade, you are aiming to capture the expected movement over that time period, showing seasonal patterns. In 2022, with valuations so stretched, everyone is looking for an edge. Seasonality is one such opportunity this year. I run backtests to find seasonal patterns in stocks as well as ETFs, and you can leave a comment below to request I run such a test on your stock or ETF of choice. In the meantime, here are a few seasonal patterns you can consider trading. The US market tends to show weakness starting in September and into mid-October. Uranium prices and ETFs tend to rise in November into the subsequent year. Precious metals, such as gold and silver, tend to rise in the summer. Stocks in the housing market tend to peak in the summer, coinciding with good weather and families moving into new homes before the school year. A short position on heating oil in January almost always works. You can also swing trade it, swinging to a long position from February to April for more gains. The Santa rally is well known and describes a proclivity for the US and UK markets to rally in December. Again, for more seasonal patterns, leave a request in the description below. Number 4, earnings trades. Nearly 1 decade ago, shorting Netflix into earnings caused my account to blow up. At that time, I had just moved to Japan and I had no social support system in place. I could not afford rent and I had to live homeless in Kyoto for a couple months, sleeping under a bridge. Because of that event, I committed myself to understanding earnings and with an emphasis on predicting how stocks will react to earnings. Now I can predict the earnings movement of a stock to a reliable degree, giving me a high risk but high reward trading strategy for my toolbox in 2022. With earnings trades, you can see triple-digit ROI in under 24 hours, provided your prediction is correct and you run the trade with options. In short, an earnings trade is when you take a position in a stock right before the company reports its quarterly earnings. That means you're taking a position at the end of the day as companies report earnings when the market is closed. You then close the position the following day at the open, capturing the movement spurred by the earnings report. Predicting earnings with consistency is a difficult task. I spent years poring over the financial literature and backtests to get my current method. I'll give you some of my useful heuristics though. First, only trade stocks that are volatile over earnings reports. Stocks that barely move over earnings reports just don't offer enough profit potential. Look at the past movements over earnings in that stock first, so as to filter out those worth playing. Second, look for quarterly patterns. Some stocks might look to be random over earnings when you consolidate all earnings movements. However, sometimes when you look at the stock quarter by quarter, such as looking at only quarter 1 earnings reports, you'll find the consistency of movements in a certain direction. Third, look at the risk reward in the direction you intend to take. For profitable companies, EBITDA to EV is a good guide. Anything above 0.08 tends to be a good long opportunity, and anything below 0.06 tends to be a good short opportunity. For unprofitable companies, such as tech companies in their growth stages, you want to look at and make predictions for the key metrics that have driven earnings-related movements in the past, often subscriber growth or monthly active users. Fourth, look at recent earnings reactions of other stocks in your targeted stocks industry. This is a really good one and really important. You generally want to bet in the opposite direction of the earnings movements of those peers of the stock you're looking at. For example, if you're looking at playing eBay and you found other internet retail stocks have sold off at earnings this quarter, this supports a long position on eBay over earnings. Be aware that earnings trades almost always coincide with gaps, so get good at gap trading if you want to close the trade with some extra profits. For more on earnings trading, look at my exposing earnings chat room at Seeking Alpha, also in the description. Number 5, Markov or overnight trading. You won't find the term Markov trading anywhere online, as it's a term I coined myself. The phrase refers to Markov chains, a type of probability model that analyzes states. For my applications, those states are the possible statuses of a stock at market open and market close. The states follow: gap up at open, gap down at the open, green candlestick at the close, red candlestick at the close. Markov trading, in essence, is playing the probabilities between these states. In the volatile markets of today, the movements between those states can be big. With a few option contracts, you can make a few $100 or $1,000 per trade as the targeted stock makes its movement from one state to another. Note that the trading between these states means that we will hold the stock either during the day, the full day, or overnight. Personally, I prefer overnight holdings because the movements tend to be as large as daily movements, but without forcing us into the theta decay that comes with holding options during the trading day. I sometimes call this overnight trading, where I am taking a position at the close and selling it at the open, essentially playing the overnight gap, and I usually do this with options, long options. Because the probability transitions gradually change over time, I don't have any heuristics to offer here. I run backtests all the time to find good overnight holding opportunities. For example, at the time of this video's creation, the overnight trading pattern I found in the SPY is to buy puts at the end of the day if we see a green candlestick, and to buy calls at the end of the day if we see a red candlestick. The former gives a 75% win rate with an average profit of $147 per option, and the latter gives a 67% win rate with an average profit of $174. In addition, you can buy SPY options even after 4:30 p.m. Until 4:30 p.m. So you can open a position after confirming the candlestick. By the way, those values and numbers I gave were when I wrote this script, which I think was in late September. So if you're going to try to attempt to use this right now, please leave a comment before doing so, and I'll rerun that back test to tell you how the Markov chains work out at present. Anyway, I send out these Markov chains and overnight trades in my newsletter, which you can find in the description below. And we play those quite often, just holding a position overnight, making a couple $100 or losing, $50 or so. As long as you're on the side of probability, you're going to win overall, and it's kind of just a good way for some extra income over a long period of time. You're just making money overnight. That's the idea here. Anyway, here is the conclusion for this video. Let me just leave you with a few thoughts. All right. So first, let me say that when I first started trading, it was really tough to build a reliable system because I just hadn't spent enough time testing all the potential trading strategies. I spent years building this toolbox that I currently have and figuring out which strategies were optimal before settling down with the ones that have been working well for me. So it's a long process where you're testing new stuff all the time, and if it works out, you keep it in your toolbox. If it doesn't work out, you ditch it. And I know a lot of new traders like to take shortcuts, so they'll read a book or they'll learn from YouTube or whatever. And those shortcuts are okay a lot of the time. But some of them, such as these black box trading signals you see online all the time, check out AmericanBulls.com, for example. They have real drawbacks, and some of them are just outright wrong. American Bulls is one of those, by the way. So, like these black box situations where you're paying for signals and you're not sure how those signals are generated, well, certain market conditions might be the assumptions of such signals, and you have no idea what those are, so you don't know if those signals are actually working during the present market situation. Other shortcuts like having a trading mentor or being in a Discord group, they have almost only advantages, I guess you could say. But these shortcuts are kind of like you're not using your own trading strategies. You're copying others, which is fine if you just want to make money. But if you want to become an independent trader, you gotta figure your stuff out. So you really gotta test new trading strategies, see if they work for you, and if they do, keep them in your toolbox. If they don't, ditch them. Otherwise, if you just want to make money, yeah, sure. Hire a mentor, join my newsletter, join a Discord, and just copy other people's trades. If you want a legitimate shortcut, of course, to becoming a trader, sign up for my newsletter. I'll tell you what I'm trading. And you can also email me and give me your trading strategies. Ask me to backtest stuff for you. I'll do that for sure. If you've got any other questions, just send me a message, whether through my website or here in the YouTube comments. The same goes for video requests. I'm always looking for video ideas. And please give this video a like. The more likes I get, the more encouraged I feel to make content like this, and also subscribe. I'm trying to get to 10,000 subscribers ASAP. So I would really appreciate that. See you next time.